Hello and welcome to Author's Note, the morning after the US election. I'm joined today by Michael Hampden-Turner, a global strategist at Citi. So, Michael, can you tell us about the result?
Sure. Well, so far we've got 303 electoral votes for Obama, which puts him in a good majority. It's been much, in terms of the popular vote, it's been a much tighter call. He's only marginally ahead. This is typically not a good sign. People feel that if you don't have a lot of the popular vote, then you don't get a good mandate to govern. But on the whole, over the last 20 years, that's the way it's been, and we've had very close calls in terms of popular vote.
And is this what the market expected?
Yes, you can see here that essentially this was broadly expected by markets, really from the point at which you can see here, this was where QE came in September. This increased his chances of electoral victory a lot. There was some good results coming out economically, and you've seen that this result essentially is broadly in line with market expectation. Therefore, we expect a relatively muted reaction.
Have we seen anything move much, or?
I think we've seen, so dollars weakened, we've seen equity markets lift a little bit, we've seen treasury yields come in a bit, but the biggest mover has been gold, which we've seen rally 3% off its lows last week, and it's now about 17.25. So we've had a good reaction there. And essentially that's a sort of QE positive reaction, an assumption that QE is going to be last for a long time, well into 2013 and 14.
So what can we expect going forward in terms of the composition of the House and the Senate?
Well, the Democrats won the Senate by a relatively comfortable majority, but they've lost the House. They gained a few more seats. They gained 15 seats over last time, but to be honest, that's not enough to make a difference. So, as far as markets are concerned, that's a continuation of the status quo that we've had so far. One thing worth mentioning in this graphic here, you can see that that markets interpret this rather badly, because essentially the politics in the House has been very polarized. You can see here that that politicians essentially been voting along party lines more so than at any other time in the last 100 years. So it's very much a case that going forward we're going to have to do deals, and this has a lot of implications for tackling the fiscal cliff in January.
And so what we should expect in terms of dealing with the fiscal cliff going forward, given this polarization. I believe you showed me this graph from the CBO showing the deficit projections. So what should we be looking out for here?
Well, what markets are concerned with is that we ride over the fiscal cliff. In other words, that we've got a lame duck session coming up, and there's an expectation that deal might not get done during this period when, before the Congress starts to sit and before the President is inaugurated. And the risk of going on the fiscal cliff is that it's a massive economic shock. It's worth about $500 billion, and economists think that it might be worth as much as 1.5% of employment, or 1% of GDP. It's a relatively big shock, and the fear is that for political reasons that politicians decide it's better to allow us to go over the fiscal cliff and then try and cut a new deal afterwards, which would be quite a sort of market negative. So that's why investors are concerned about a failure to cut a deal in the next couple of months.
Looking at this chart, though, I guess there are some people who would see the deficit going down like that and would actually be quite happy. So when you're talking about these shocks, how do you relate it to what some people would regard as a positive almost?
It is a positive in that you're cutting the deficit, which does need to happen, but it's a negative in that this means sacking a lot of people and unemployment rising, and therefore this has is a net shock for consumers and corporates generally. So what they're looking for is a deal which essentially makes this a more gradual process, so we see the deficit coming down over a much longer period, maybe when the economy is a bit stronger. So the fact that we're being forced to drop off is bad news for equities and bad news for corporate bonds.
So, and in one line, where do you think we're going to end up?
Over the past couple of years, the Democrats and Obama in particular have been quite good at cutting deals with the Republicans. They've managed to get quite a few chunky bills through the House, and I think they're going to manage to do that this time as well.
Thank you, Michael, for joining us today. And there we have it. Fiscal cliff still to be resolved.